All right, welcome back. We've got a Amazon earnings update. Amazon came out with their earnings a couple of weeks ago, so we're going to do a deep dive into their earnings. If you want just a quick little snapshot, I'll give it to you here at the beginning of the video, and then if you want to stick around for a little bit more detail, watch the whole video. So, in a brief snapshot here, Amazon was down pretty hard on their earnings. I think they were down 20% at their worst, at their lowest point after earnings. I would say a lot of that is due to the soft guidance and the rising concerns about softness when it comes to the consumer. So, but for me, looking at the numbers here, I love what Amazon's doing. Amazon is my second largest position. I did scoop up some Amazon on their earnings drop a couple Fridays ago, and I'm underwater on that position, but I don't mind one bit. I want to continue to accumulate this stock, and the fact that it's at a lower price to me is a good thing. So let's get into a couple bullet points here. So their advertising is up 20% year over year. That is the fastest growing part of Amazon's business. You've got their Prime Video, you've got the advertising in the online store, and also the in-store Audible. A lot of ways for them to charge for ads because everybody uses Amazon. They got a lot of customers, a lot of eyeballs. Companies will pay Amazon to get their products in front of those customers. So, and that's a high margin business, right? Google is pretty much all advertising, Facebook advertising. So now Amazon is really starting to take a piece of that pie as well, which is good to see. Now, when it comes to Amazon Web Services, that is up 19% year over year at a 36% profit margin. So that's good to see as well that it is continuing to grow. And again, that is fueled by some of the AI addition as well. But AWS has been a huge story for Amazon for a while, even before this recent surge of AI. So that business is doing well. It continues to do well. Their free cash flow was 53 billion versus 8 billion a year ago. So this has been one of the biggest reasons why I've been accumulating a lot of Amazon is because they're cutting costs and they have a lot more profit and they have a lot more of this extra cash that they're able to reinvest into whatever they want. And eventually that cash will be given to the shareholders in a buyback and a dividend. But I do like that instead of giving that money back to us now, they're investing that into other potential growth drivers down the road in these new business ventures that they're doing. So they're throwing a bunch of money into AI. They're throwing money into their satellites. They're throwing money into their robotics so they can cut labor and be more efficient. So I like what they're doing. The fact that they have a ton of money, a ton of capital to do whatever they want, I really like that. And then when they run out of ideas, then they'll give that money back to the shareholders. But for me, I want them to keep growing. So that to me is great to see. Just the continued improvement in their free cash flow and their profitability. So they did say in their earnings call that they are going to continue to increase their Capex, their spending. So their Capex increased by 58%, and that's driven by AI investments. And they did mention in their call that the second half of the year, they're going to spend more than they did in the first half. So look for them to continue to invest in semiconductors, into the cloud, whatever they see fit to continue to grow the business long term. And their guidance was a little soft. It wasn't anything crazy, but it was softer than the market's expectations. And we'll pull up the chart real quick here because as you can see here, waterfall after the earnings. Now we did have a nice run up to the 200 mark before earnings and we kind of bled into earnings, but once earnings hit, we went immediately from 180 to 150. Wow. 151 at the low. So that's a big drop. And we've recovered since to 166. So it'll be interesting to see if Amazon if that was just a nice little pullback or if we just kind of go sideways. But for me, this is a great price to pay for a great business. So let's look at the earnings snapshot. again, revenue for just this past quarter, $148 billion in one quarter. So Amazon, I believe, will probably be the first company to get to $1 trillion in revenue within the year. 148 billion, pretty good. So I'll let you hit the pause button and take a look at this, but we kind of went over the main bullet points here. The big thing here is their margin and their profit is increasing, so that's good to see. And the more that they can keep cutting cost, the more operation profit, gross profit that they'll continue to have, and then they can reinvest into whatever they want to do. All right, so that was the quick and dirty. Now we're going to get into a little bit more detail. I'm not going to read off all of these, but we're going to go through some of the main points here, and some of these we already talked about. But you can see the revenue breakdown. Online store is still 30% of overall revenue. And then after that, 24% is going to be the commissions, fulfillment, and shipping. And all of these are up year over year besides the other. I don't know what is in other, so we'll have to wait and see. But international, they're doing good. That's up 10% year over year. Gross margin was 50%. Operating margin is 10%. So I think this is also another key reason why the stock dropped, is people want to see this margin grow a little bit faster. And they did guide for, I believe it was a 7% margin for the next quarter. So they're guiding for their margin to go down again. They're going to be spending more this second half of the year, so there won't be as much profit margin. So we'll have to see what that looks like. And they did guide for lower revenue, so less revenue, more spend, less lower operating margin, and the market doesn't like that. But again, here on the cash flow, operating cash flow, 108 billion, up 75% year over year. Pretty unbelievable. Free cash flow, 53 billion versus 8 billion a year ago. Primarily driven by the operating cash flow improvement. Purchases of property and equipment only grew by 2% to 55 billion. So balance sheet looks good. Cash and cash equivalent and marketable securities at $87 billion. Long-term debt at 58 billion. So they have a lot more cash than they do debt. It's good to see. And then when it comes to the guidance, revenue growth between 8% and 11% year over year, a slight miss on the mid-range. And then here you go, operating margin between 7 to 9% for Q3. So a lot to like, in my opinion. I do see how the market doesn't like the guidance for the next quarter. And again, here we've got the advertising, 20% year over year. Let's see, the Capex is up 58%. We already talked about this. And operating margin improved by Amazon Web Services alone for 3 percentage points of the overall margin improvement. So I did kind of see a lot of people talk about how they should just charge more for the shipping business, because I don't know about you guys, when you order stuff, I don't need the deodorant that I bought to be here tomorrow before noon. If it would save Amazon some money to give it to me in 48 hours, I'm okay with that. So typically when I order packages on Amazon, I say deliver it, a couple days later, pack packages together. For me as a shareholder, I know that saves them money, but also a lot of things that I buy online, it's not urgent for them to get there the next day. And Amazon can improve their margin drastically if they can be a little bit more efficient on the shipping business, the e-commerce business. But I do see how they want to keep luring in customers and keeping people stuck in their ecosystem by providing that awesome service. Because Amazon is a great service, everyone uses it, but there's no way they make money on that by shipping me deodorant in 24 hours, right? So if they make money, it's a razor thin margin. So they can get a little bit more out of that if they charge a little bit more for shipping, charge a little bit more for the Prime subscription, or lengthen the time of delivery. So I did hear a lot of people calling for some more improvement and more efficiency when it comes to the e-commerce side of the business, because they are seeing some profit margin, but or some margin growth, but that's all from the cloud. So people are wanting their shipping business to become a little bit more efficient. Um, let's see here. One of the other things that was interesting was when they were talking about AI. They're doing a lot when it comes to AI. They talked about their 3 layers of AI. They have the infrastructure, the models, and the applications. And they kind of just talked about how they're making their own chips, they're making their own large language models, and then they're making their own applications to build on top of that. But also they're allowing developers to use other people's models, but have the security of Amazon Web Services. So, Amazon, they are a huge AI play. Um, Maybe they don't have the chat GPT where an average consumer can touch it and feel it, but they're the backbone that is running a lot of these models, right? So Amazon Web Services is running a lot of the internet that Meta is using for their AI models, and these other companies. And Amazon does have a significant investment into a open AI competitor called Anthropic, and that's going to be a big winner for them down the road as well, hopefully. Um, so when you hear the earnings call, it was interesting to hear them talk about a lot of their other bets. So they talked a little bit about what they're doing in AI with Anthropic. They're making their own chips. And then one of the other things they talked about was their project Kyper, which is it's like a SpaceX in a sense, where they're working on launching satellites into the sky to have a Starlink type internet competitor. So they did say that they're accelerating their satellite manufacturing in Washington, and they see significant demand for services from enterprise and government entities. They expect to start shipping production satellites later this year, and they believe it could be a large part of their business. Um, so that's interesting. They have all these other bets. Remember, Amazon, AWS was one of those other bets a long time ago, and it just turns out, oh, that's our most profitable and fast growing part of the business, and one of the biggest drivers for Amazon. So they have a lot of other kettles in the fire, if that's a good saying, but they are working on a lot of other projects that could account to be something very substantial down the road. And again, it's great that they have the continued improvement in margin, where they have more profit that they can go invest into these other side gigs, side businesses that could really develop and bring some more revenue to the bottom line. Let's see here. This highlight, again, we expect capital investments to be higher in the second half of the year. And they did talk about their investing. It looks like money well spent in the AWS growth as it's accelerating. They did reach a deal with the NBA. I believe there was 2 other companies. So that's good to see that they're going to have more NBA, NFL games, people having to watch on Prime. And it's pretty interesting. I'll highlight or read this off here. Prime is expected to reach 180 million US members in 2024. As a result, Amazon created a giant ad-supported streaming platform overnight. For context, Netflix has 84 million paid memberships in North America at the end of June, and only a small fraction of those opted for their ad tier. So another thing Amazon did recently is, if you watch on Prime Video, there's going to be advertisements unless you pay $3 a month. Here it is, $3 a month to get rid of the ads. So think about that. If you have $180 million, and let's say 80 million of those people say, I don't want to pay for ads. I mean, you do the math there. So just another way for them to be cranking out some revenue. So it is good to see. I mean, the NBA deal and the NFL deal, that is a big cost to them. But as you saw, Amazon, they've got the cash, so they can spend a little bit of money, and then the money that they're spending, I'm sure they wouldn't be spending it if they know they're going to lose money long term. So let's see here. I got some graphics we'll wrap up with graphics. So you can see AWS starting to reaccelerate again, and again, it's reaccelerating at these large numbers. So I think it's $28 billion this past quarter and growing, which is phenomenal. When we look at the cloud infrastructure market share, AWS is the leader over Microsoft, over Google, over everybody, and it's a big lead that they have right now. So that is great to see. Let's see here. We've got another chart here. The operating income in orange and revenue in black. You can see both of them moving in the right direction. So not only is Amazon just raking in the cash, they're pretty profitable as well. And then when you see advertising revenue, pretty surprising to see that Amazon gets more advertising revenue than YouTube. That's pretty unbelievable. You can still see here Google is the big dog. Google's the gray bar. You got YouTube the red, Meta the blue, and then Amazon the orange. So I don't think a lot of people really quite understand that Amazon gets more advertising revenue than YouTube. When I say that, it doesn't sound right, but it's true. 12 billion for Amazon, and what is that? 8.7 for YouTube. So pretty awesome. I didn't update the pros and the cons, so we'll leave that be. So for me, this is a solid quarter for Amazon. Like I said, I did pick up some shares. I actually had a put that was exercised at 175. So I'm underwater about $800 on these shares that I bought recently, but no problem. I'm not worried about it one bit. I will look to buy some more if we get back down under 160. But it is my second largest position, so I'm going to be very picky on price. This is not financial advice, but if I didn't have any Amazon, I would not mind one bit buying Amazon under 180. And it's at 166 right now. So a great company at a great price right now. I think their earnings were fine. Now when we zoom out a little bit, let me see here. We're on the weekly chart. I do think Amazon is a $200+ company. Now you can see we haven't gone anywhere since 2020. We are at the same price that we were in July 6th of 2020, which is pretty unbelievable. So we had a nice crash, we had a nice move up, and we're literally just gone nowhere. So I like to see that because I think there will be a nice leg up like we saw during the pandemic here. I think people will realize, oh wait, Amazon's a crazy good business, and then we're gonna have another leg up into the 200. So I'm positioning myself accordingly for another move like that. When it'll happen, I don't know. But I can go over all kinds of valuation ratios, and I can go over all kinds of metrics. But to me, Amazon is it's a great company at a good price. We can look at some of the financials here on TradingView. Price to earnings is 39, which is not bad at all. Yeah, we're not going to look at too many of these. It's easy to get lost in the sauce on those. So that's basically all I got for this earnings update. I hope you learned a little bit more about Amazon. So let's see what the price action does. I hope we can fill this gap eventually. It looks like we probably will within these next couple of weeks. So Amazon on sale, I'll take advantage. So anyways, that's all I got for you guys. Have a great rest of your weekend. Peace out.